All right, so brokers, we are going to get started. I have Willie Newman, President and CEO of Home Point Financial. Home Point Financial, as everybody knows here in the Brokers Are Better group, partner lender. They initiated the Customer for Life for the broker community last year. That now seems like a distant memory because we got so much going on today that we're going to talk about. Willie, how are you holding up?
Well, as I said offline, Anthony, I'm not really sure to answer that question these days, but we're doing well as can be expected, I think, in this environment. And, most importantly, I'm glad to say all of our associates are safe and healthy at this point.
That's great. And what percentage of your team is now working from home?
So we have 91% that are working remotely, and we have another 3% that rotate in and out of the office. So 6% on site, 3% in and out, and 91% off site.
Wow, that's impressive. And how many team members do you have?
About 1,600.
Wow. And right now, I mean, I guess from a volume perspective, how are you guys wrapping up March? Is from a overall just compared to this time last year?
Well, compared to this time last year, it's dramatically more. As you might recall, last year first quarter, entirely different experience. We'll fund over $3 billion as an organization in March, and that will be the end of a solid funding quarter for sure.
Wow. So what was your best month in 2019?
It was right around that number as far as funding goes. So I think this will probably technically be a record for us.
Wow, that's great. So, I'm going to get started. We have a lot of stuff that we're going to cover. First thing I want to ask you, because and our audience and all the brokers at this point, we've been delivering pretty repetitive messaging about what's going on in the market. We've had a lot of interviews with people in capital markets and leaders of lenders, so they understand that although rates are low, the crisis is 100% upon us when it comes to not just the health crisis, but also the crisis that lenders are facing when it comes to financial pressures. How have you been? What are the things that you have been surprised about or dealing with here over the last 2 to 3 weeks that has maybe you've never dealt with before?
Yeah. So, well, I think I know we talked about it, but I am an old timer, so I've been in this business since the '80s, and I don't remember at any time saying this is the first time I've seen fill in the blank as many times as I have just in the last 3 weeks. I mean, and so I think probably first and foremost it's the extreme volatility of the market. As you said, that you would think that rates would be consistently low based on what's happened with treasuries and obviously some of the economic distress that we're currently in. But bond market movements, mortgage-backed securities movements, movements in other sectors that you would think are totally unrelated to what we do in mortgage, like commercial lending, commercial CMBS, et cetera. So I think first and foremost, it's really dealing every day with pretty extreme volatility and determining what the best path forward is based on that volatility, which is, again, unprecedented and obviously unforeseen.
From just, we're going to talk a little bit about liquidity, but
right.
Everybody I've talked to, all people that I respect in a high degree, your team alone, capital markets people that I respect, everybody has repetitively told me the same thing, which is, this has never happened before. But when we talk about margin calls and we talk about some of the things that are happening on a day-to-day basis, there's genuine fear in a lot of people's voices when I talk to them about when I'm like, well, what would happen if this went on for like 2 straight weeks or 10 straight days of just these types of like movement in the MBS and in the market? And everybody's like, it just can't happen. Right. How is that? I mean, as a leader of a company, how big of a challenge, how hard is that to manage?
I mean, it's tremendously difficult. I think, we're a non-bank mortgage company, so we depend on leverage from financial providers in order to run our business. And so they have their requirements, they have their pressures. They're feeling the same volatility that we are, and it's hard to plan for something that has never happened. So all those pressures kind of come onto us every day, and so you have to make decisions really on the fly. But have an overarching, at least from our perspective, Anthony, have an overarching framework of what you're trying to accomplish, your partners and what they're experiencing, and kind of how can you put it all together in a way that minimizes the volatility and disruption, but recognizes that there's risks involved.
So on the leverage side of things, the question I would have is we did an interview earlier this week with somebody in capital markets, and they made a statement saying, the secondary market is unforgiving and brutal and can be very brutal. During a time like this, when we think about things like margin calls and MSR write-downs and all these things, is it very just straightforward, like this is what you owe, stroke a check, send us a wire, or is there any type of, can we talk through this? Is there a people part of it?
Well, I would say that there is an element of the latter, but it's much more the former. So I think from like strategically for us, there's a number of times where you could be frustrated with something and you could say, well, this is a risk, but in an environment like this, you really have to pick your spots. And I think for us, our strategy of really, I'd say having fewer partners from a leverage, whether it's warehouse, whether it's how we finance our balance sheet. Obviously, Stone Point Capital has been a tremendous partner, from a capital standpoint. Having kind of fewer, stronger, deeper partners, I think, has been a benefit to us. But there are plenty of conversations that take place. But from kind of day to day, it's kind of like, here's what you owe, or here's what you owe us. Especially from a hedging book standpoint.
So on that side, we will go into liquidity. I spoke with somebody yesterday that is very much in the know when it comes to mortgage bankers and hedging. There are some numbers that are floating around of potential margin calls that lenders have faced here in the last week, as big as $1 billion in a day. And these are from non-bank lenders. So when we think about that number, and obviously for it to be that number, it's has to be a big lender, but $1 billion in cash. How many non-bank lenders have have the chops?
Well, I would say probably zero. And to your prior question, I think when it gets in circumstances like that, one, there have to be discussions. Two, I think what I would say is that the agencies and the regulators have noticed or understand there are issues that come from that. I mean, you simply can't say you're out of business because you can't meet this call when some of the largest non-bank lenders in the country. Well, to be perfectly blunt, all of us to varying degrees have that pressure on us. It's just a matter of how much and the timing associated with it. So. It makes it difficult to navigate every day, and I think probably for a year, especially for the people that are watching this, it does impact how we price to you, how we deliver service, how we adjust what we're going to take in from a credit standpoint. It impacts all of that. So you are impacted, kind of downstream from whatever the pressure is upstream for us and others.
Yeah, and that's been the big theme. I mean, last week we saw the collapse of the non-QM market, which is truthfully very people don't like, there's three levels of the way people look at these things, and the first level is obviously for the loan officer community is my consumer. So I had a loan that was supposed to close, my consumer's not getting a loan, and I think there's two sides. There's the short-term impact, and there's a long-term one. And what I try to tell my audience at least is, hey guys, like I know that whoever is not doing this loan, but the reason why they're not doing it is valid, meaning it's a liquidity issue. Like, do we believe this customer is going to make their payment with 25? If we go to 25% unemployment, are they going to be able to make their payments? And maybe in some of these cases, we're doing the consumer a favor by not giving them the loan. Maybe they would have gone into foreclosure. Maybe something derogatory would have happened. So there's that part, but then there's also these companies have employees and they're laying them off, and obviously that's the last thing any of us want to see happen. You guys had the Edge programs. Mm-hmm. How quickly did that non-QM market just disappear? Oh,
it was literally like a day or two. I mean, I think it went from being on our watch list and us kind of dialing back because we were concerned about what would happen from a liquidity standpoint to it's done. And it wasn't just one provider or one investor. It was kind of across the spectrum almost instantly. And I think that's one of the elements of this situation that's different. I think in financial crisis, things happened, but it wasn't as rapid as if you kind of look back and say, on this date, this happened. There was a lot of things that were happening before that. This was kind of like one day you woke up and this was done.
And on that note, you obviously don't securitize those liens. You don't keep those loans in your servicing, right?
Right. That's correct.
So how does that impact you? Do you have loans that are not being bought? Do you have loans that are exposed to this?
No, not to any meaningful extent, because again, we had dialed back prior to kind of seeing, I guess our playbook, for lack of a better term, Anthony, is whenever we see, kind of, the dark clouds approaching, it's to simplify. So, we looked at what was most complicated. And again, it wasn't just the credit spectrum. It was what's most complicated for us to do operationally. And, let's start to narrow down what we do so we can focus on what we think, we're going to be best at in that environment, what we think will be less risky for us in that environment, and what we think we can do with our partners to provide them the best possible service. Even if it's a narrower spectrum, we're still going to get stuff done with them. So we started simplifying before, fortunately, before some of these cliffs got fallen off.
That's good, because I'm talking to some much smaller players than Home Point that don't have the liquidity, and they're kind of stuck with some loans right now that they don't know what's going to happen with. So on that side, we've been talking a lot about what's going on in the government lending space with Ginnie Mae backed securities. I've shared with brokers that this is not a broker issue. This is an industry issue that's going to happen. That's going to evolve. We saw some lenders start to come out with, hey, we used to go down to 580, now we're at 640. We used to go up to 55 DTI, now we're going to 45. But realistically speaking, if we see the companies that traditionally buy servicing not in the market to buy servicing, that credit box is going to get very small, I would imagine. There's no question. I mean,
kind of starting again with your premise that it is, we believe, I don't want to kind of value judge, but we don't think it's in the best interest to provide for us or the consumer to provide the consumer with a loan that they fundamentally cannot pay. That just doesn't seem like it's in our best interest. And I think you have to start making the assumption that there is just a narrower spectrum of customers that can pay and a broader spectrum of those that it's going to be very challenging in this environment. So, and anything that is either more credit challenged or, even a little less liquid is going to just get hit more in this type of cycle. So again, we simplify, try to provide the best service we can for the broader spectrum of borrowers and our partners, but in a way that we think is responsible based on the circumstances that we're seeing now.
And on that government lending side, I think one of the interesting things that this may end up leading to, hopefully it does, the entire revamping of the way Ginnie Mae securities work. What we've seen is that essentially when a consumer goes into default, servicers, has to make their P&I payment for them. I shared with everybody what that impact could be. When we talk about right now, we saw 3.3 million people lose their job last week. There's estimates from the Fed the Fed chair in St. Louis, James Bullard, that unemployment could be 30%. And when we think about that, 1 out of every 3 consumers losing their job, that means 1 out of 3 consumers not making their payment. And that also means the servicer now has an obligation to make those payments. Now, I know that the industry is preparing for some type of semi bailout from the Fed for servicers, but that's only going to solve for the servicing problem of existing loans. That's not going to solve for the liquidity issue when it comes to new government loans.
Right.
So this is something that could potentially go on for quite some time.
Yeah, I don't think there's any question. However long this lasts, their reverberations from it will be much longer. And to varying degrees, and again, it's hard for me to predict kind of what that looks like, but certainly if it's riskier product, which we know government lending is, if there's more kind of strictures associated with it, which is what you're talking about with regard to advance. Not only do you have to advance as a servicer, the rules associated with how you advance and your adherence to them, that is what will make the difference between us recouping the advance in a normalized circumstance and us not. So there's already an element of risk before you even start the scenario that we're going into now.
How does, from your perspective, when we talk about this issue, how does this compare to the financial crisis in 2008?
Yeah, well, so maybe a little known fact. Well, probably those that know me know it pretty well, but I guess I was fortunate enough when the business that I was running was sold in 2007. I actually wasn't working during the financial crisis, or at least now, I guess I got to see it from afar. So it's hard for me to say, kind of at the day-to-day intensity level, but certainly those that I work with who were kind of in it during the crisis are saying this is worse. if you think about it, there's two dimensions to it. One, this is certainly more violent. It's much more rapid. If you look at some of the charts, like on REITs as an example, you see the REIT kind of popping up, and it just falls off a cliff.
Yeah.
I think, so I think that's one dimension. Second is, this is not a financial crisis. This is a health, a public good crisis that is driving all kinds of other crises, employment and, the financial mortgage, other financial services, et cetera. So I think that's a whole different dimension, because it just brings in variables that whether people modeled the financial crisis or not, there were financial models that assumed some sort of disaster scenario. Whether it was extreme enough or not, you could debate, but there's no model for this.
Yeah, that's becoming more and more clear. For you, when you think about, hypothetically, this goes, let's just say it goes for either 3 to 6 months. What, for the industry, do you clearly look at as the fallout? And when I say the fallout, obviously we know, hey, servicers are going to get bailed out. There's going to be liquidity bailouts that happen. But overall, as an industry, what do you think the things that are on the other side of this? What does this industry look like moving forward? Because on the other side of the financial crisis, obviously we had Dodd-Frank, we had a much different environment than we had before. This is a different crisis, not driven necessarily by predatory lending. But what do you think is going to be happening?
Yeah, I'll look at it kind of from our lens first, which is, it's hard to imagine that there won't be a greater degree of capital required and liquidity required to be in the business, or maybe be in the business as a lender, we'll say. So I think that's certainly going to be one of the impacts, and that trend was already kind of taking hold with what Ginnie Mae was looking at with regard to large servicers, with what the FHFA was looking at with regard to capital requirements overall. So I think that this is just really kind of I don't know, for lack of a better term, ground zero for what happens when it's a pretty leveraged type of an industry. I think there has to be a long look at the capital requirements. The second thing is, it's hard to imagine, and this is where I probably get in a little trouble. It's hard to imagine the government not being involved in the mortgage business. So I'm not sure what will happen with the momentum of FHFA around releasing Fannie Mae and Freddie Mac, but there's going to be some high degree of government involvement, whether it's specific to a program or more generally with the agencies, and there kind of has to be. So,
I mean, honestly, it's disappointing for me, because I've been holding on to my Fannie Mae and Freddie Mac stock for a very long time, hoping for this privatization. But fundamentally speaking, this market has proven very quickly that there's just no way that they can be out of the mortgage business. I mean, I think we're going to find out in the next week to 2 weeks how badly some people are off when it comes to liquidity, but it's not good. And and realistically speaking, if it wasn't for some of the things they've already done, where would we be right now?
I mean, well, without the buying program that was put in, especially the announcement of unlimited buying this week on the MBS, the market last Thursday, the market was not functioning in MBS, which again is another first for my career. And like I said, it spans a long time. So, and when it started functioning, it was functioning at spreads, bid-ask spreads. So, buy to sell, that were greater than, again, when the old timer started his career. I mean, in the mortgage markets back then were more like, here's the security, So I mean, that's where it got to. So without that unlimited buying program, it would be hard to see a functioning market at this point. On the other hand, the buy program, which has really bolstered prices, is part of what's caused this kind of a challenge with margins.
Yeah, that's an unforeseen consequence. That when they announced the buying program, I think there was a big hooray. But right now for mortgage bankers, this has been a brutal week. I mean, we're seeing margin calls like we've never seen before, and I think that's a great segue into my next subject, is really partnership continuity. This subject that we've been talking about now for 2 years, true partners and all that stuff, it's taken on another context now. And when I think about it, I feel like I'm getting a master's degree this last couple of weeks in capital markets. It's amazing how impactful behavior is to all the entire system. And when I think about things like, hey, I locked a loan and pricing got better, I'm moving the loan to another lender. That's a behavior that brokers for as long as there's been wholesale have taken advantage of. But that is something that has to change, because right now lenders are going to start announcing very soon, both in wholesale and retail, that in order for us to allow a broker or an originator to lock a loan, you're going to have that loan in a disposition of approval, or potentially even clear to close. And it's for a simple fact that because the guarantee of the closing of the deal and the consumer's credit quality and their job are so unpredictable right now, that the hedge costs are just burring lenders.
Yeah.
And I think that's an opportunity, because I think right now that's a big part of the conversation, is how do we be better partners to our lenders so that they're best positioned for, long-term success. So, we had Melinda Wilner on yesterday for an interview. She's the chief operations officer at UWM, and we talked about the VOE issue. And understanding that, hey, I got the VOE, borrower is good, go in a closing, and you find out from the borrower that between VOE and now they lost their job.
Mm-hmm.
Again, the borrower's about to close on a loan and save some money, technically monthly. But if they lost their job, the likelihood they can actually repay, whether the payment's $1,200 a month or $1,500 a month, it doesn't matter. If they can't pay, they can't pay. But what that would do to the wholesale lender would be really bad when you think about it at scale. How important is that from your standpoint right now? Like, loan originators, at the end of the day, they're not your employee. The brokers are not your employees, but you look at them as an extension of your company.
No question about it. So I think what you're identifying, Anthony, is there are circumstances where I think anyone can kind of talk themselves into saying, okay, this is a rational act, or this is okay because it's allowed. But all those actions, such as moving loans that are already in process, or churning customers that are in a service portfolio where the economic benefit to the borrower is marginal, but the economic benefit to the originator is significant. The servicer gets left holding the bag, so to speak. All those have hidden costs that maybe aren't as clear on a transactional basis because they don't get applied, but they're all in the system. And so the more we get those out of the system, and especially if kind of we together can work together and behave, that just drives down the cost for the borrower. It drives the opportunity for us collectively to capture, kind of optimize the revenue associated with it. And the process is just better for everybody. So I would hope, and I think what you're seeing to varying degrees is, to your point about, what might change or what might get adapted especially in the short term on submissions. It's like, there's a great responsibility that goes along with what we're doing. And if you abuse that responsibility, things have to change. And the cost associated with hedging right now is extreme. So it's really shining a light on the fact that these actions do have hidden costs. It's just, again, having a light shined on it. And this is the opportunity, hopefully, for us to, clean it up.
Yeah. And I would say that when I look at what's happening now, because this is a crisis that's impacting the entire market from originator to servicer, the one thing that I look at when I evaluate this, and this is not going to be popular when people hear it, but I sat down with my team and I just said, okay, let's really look at, depending upon how long this goes and how big the fallout, what is the reaction going to be when people actually dissect this? And they're going to start to think about the commissions and the compensation that's paid on the front end of the transaction. And this isn't just a broker thing. This is a loan originator / mortgage bankers as well, is understanding that I think we're going to see a pretty dynamic change in the way compensation is structured on the other side of this. And the reason why is skin in the game is such an important part of the economics of lending. And when you have a model that's solely based upon the likelihood of payment, the likelihood of default, the likelihood of prepayment, you're betting on a loan performing for a period of time. And when it's structured like that, and you have a clear history of certain level of prepayment and a clear history of default, especially right now, we're about to have a massive amount of default. People are going to reevaluate how they pay up front because that cost, like that paying, it's a mortgage banker getting paid by an MSR or it's an originator getting paid by their company. The minute that goes out the door, it's gone. There's no recouping it. I mean, technically there's EPOs, but there really is no recouping it. And I think right now I try to tell loan originators, this is bigger than anything, is protecting the whole industry, because your next commission check doesn't matter if in a year from now, the way that we're getting paid is, delayed payments or incremental commissions on a monthly basis. So it's an important time for originators to understand that everything's going to be on the table on the other side of this.
Yeah, I think so too. And I actually just read Don Layton, the former CEO of Freddie Mac, just wrote a really good paper about kind of the risks that are out there. And that, I mean, his kind of summary of is that we should put everything on the table. We should really assess the housing finance system in the U.S.
Yeah, and I, even from when we think about from a technology standpoint, like how is it possible virtual closings not in 50 states?
Well, I was going to mention that, which is there may be some hidden benefits from this. One of which is it may help the regulators kind of unify around a process that is better for everybody as opposed to kind of protecting their turf, so to speak.
Well, I think definitively it is. Like, in my opinion, this is going to force adoption and it's going to force change in a really big way, because over the longer this goes, things that have been sidelined for quite some time are all of a sudden going to have to happen because the industry needs it. When it comes to appraisals, bifurcated appraisals, virtual closings, everything is going to be pushed through right now because they have to. Retaining servicing. I know I talked to you and Phil last year. You guys were obviously very bullish on retaining servicing. Right now, that's obviously right. This is a once in a lifetime, as we say, situation. But long term, are you bullish or bearish on retaining servicing?
Well, I'd say it's hard to be bullish right now, but we think what we call the connected value chain is what creates both. It kind of optimizes the value of the assets that are generated, which is of course mortgage loans for us. It also optimizes the opportunity to work with the customer, both for us and our partner over time. So yeah, I mean, we're bullish because it's an integral part of the value chain. It's in our opinion, the only way to maintain connectivity with the consumer or with the customer in a way that can be expanded over time in a meaningful way. At the same time, I'll be blunt, it's going to be a rough few months for servicers, and we're no exception to that.
All right, so I have some questions that I put together earlier this week that you're going to be the first CEO that I ask these questions to, but I'm going to be asking this industry leaders at your level these questions as we interview them.
Fire away.
Do you believe we will see home prices decline, and if yes, by how much?
So I've read two papers today, one of which said no, one of which said yes, but I think I'm not going to answer straight, I guess, because I think a lot of it depends on where employment goes, and is this a V-shaped employment trough or kind of shape, or is this a long term? So I don't know, but I think at minimum there's a pause, and a lot of it depends on employment.
What is the biggest risk to the mortgage industry at this point, and how do you mitigate?
Yeah, I mean, we talked about it, which is volatility and liquidity, and I think number one is you simplify. I think we've done that from product parameter standpoint, from how we operate, albeit remote, and kind of how we present ourselves, how we hedge our pipeline. We've simplified. So I think the best thing you can do is simplify, and then of course ensure, as I mentioned, that you have strong partners from a counterparty standpoint.
What is your number one priority right now?
Keeping our associates safe and sound to the extent we can. So I can give you so one of the things that we did, Anthony, that I think is important for everybody to know is that one of the first things we did was we realigned our priorities as an organization. And, of course, you have your business plan, strategy, and all the stuff you want to do and everything. Sat with our executive team, realigned our priorities. Number one is to keep, to the extent we can, our associates safe and sound. That was their number one priority. Our number two priority was to ensure operational integrity. And so, you had mentioned it offline, but we feel like we've done a really good job of being able to operate in an environment that was unforeseen. So that was second priority. Third priority was to preserve the opportunity. And preserve is a very deliberate word because we see opportunity right now. We talked about, we're doing pretty well from a funding standpoint. The market has, with albeit some challenges, there's loans to be had out there, but at the same time, we see a more significant opportunity coming out of it because it's going to be so difficult to navigate through it. So we specifically are looking at, from a priority standpoint, preserving the opportunity. So we're going to take advantage of what we see in front of us, but we're not going to do it at the expense of what we believe is an opportunity in the long term. So we realigned our organizational priorities, and everything we're doing is focused on those three, kind of centers around those three priorities.
No, that's that. I think some people were early to the party and some people were late to that party, but now more than ever, that is priorities reprioritizing. How long do you, I want to break this up into two things. I'm going to break this up into a health crisis and a financial crisis.
Yeah.
How long do you think this will last?
So we're planning for 4 to 6 months, and I'll say the health part of it, and the probably the most extreme of the financial part of it. But we think it has potentially a long tail, which could go on up to a year after the 4 to 6 month period. And again, to varying degrees, it's not like a macro statement. It could be elements. It could be real estate market. It could be the housing finance specifically. But we feel like this has a pretty long tail to it.
Yeah, I think the more time I spend with people in default mitigation, loss mitigation, I realize that for every 3 months that this goes on, there's another, basically 6 to 12 months that this will linger. And I think it's interesting to understand what the dynamics are on the other side of this.
Right.
What is your most optimistic prediction?
Oh gosh, that might have been it. Yeah. So 3 months and a V-shaped recovery. So in other words, it's a kind of quick and deep trough. We all do our roles as citizens and social distancing, et cetera. Hopefully there's some other elements that come into play, and it's V-shaped recovery. That's probably the best case scenario.
What is the number one thing you've learned in the last couple of weeks?
I am amazed at the adaptability and resiliency of our associates. So, I mean, any CEO or leader is going to say, I have a great team, right? I mean, that's kind of like, if you don't have a great team, you're not a great leader, or, there's something wrong with you if you don't at least believe you have a great team.
Yeah.
And, I believed that we did, but I am amazed at the level of adaptability and resiliency. I mean, the plan was put together. We had a BCP plan as an organization. It was meant for, natural disasters, we have 9 sites, so certain one of our sites, certain functions, the system's down for a period of time. It wasn't meant for this. And it was adapted, not by me, but by a bunch of our leaders getting together and along with our BCP and our administrative folks and saying, we got to do this. And within a week, they had adapted that plan. And, as I mentioned, we had over 90% of our associates working remote within a week of starting the plan. So wow. That's what I'm most amazed by.
When you think about that externally, and I think there's a lot of lessons being learned right now. You talked about leverage. You've talked about the unpredictability of the market. When at the beginning of the year, somebody would have asked me, Anthony, hey, what's your single biggest concern of what could happen to the broker channel or whatever? I was prepared for that. I wasn't thrilled about it, but I was prepared for what that was. Right. Looking back, this is something that wasn't on my radar, and it's amazing how no one is prepared for the worst case scenario. Everybody's worst case scenario is so not bad when you really think about it. And as a business leader, I just wonder, how does this retrain your mindset going forward in, as you build a business that, will probably deal with another crisis at some point?
Yeah. I mean, I'd like to think that I'm kind of a learning oriented person and you try to adapt. But I think, like you said, there was this, while the scenario was unforeseen, the impact, I mean, if you think some of the impacts were actually, you probably could have seen them. You just didn't envision them happening. And part of it is just human nature, right? You don't want to think about the worst thing that could happen because it's not pleasant. But I think for me, I think, we will likely overinvest in ensuring that we are an adaptable organization. And again, same thing. Leader says they are, hey, we're flexible, we're adaptable, we're nimble, all that stuff. But I think what this shows me is that we have to continue to invest in, investing in unforeseen circumstances, not just, the kind of the nice disaster scenario.
And I know we talked a little bit about the servicing end of things. Obviously, I communicated out to the broker community today the importance of not letting media or letting politicians that are not in the know or not speaking full-heartedly dictate behavior. And when I talk about that yesterday, we saw Governor Gavin Newsom come out and make some comments about, hey, you know, Californians, you don't have to make your payments for 3 to 6 months. And I think that the most critical thing I'm trying to explain to the broker community and originators and everybody in the industry is that when you take out a mortgage, it's a contract. The expectation is to make your payments. Now, stress and losing your job, there's hardship that's going to happen. But right now, when I see media outlets and I see people saying in a very assertive way that you don't have to make your payments, it's understand we have to separate a couple things here. We have to separate that there are people under hardship that's applicable to, and we have to educate them and make sure they understand what a forbearance is and how it works and all that good stuff. But there's a lot of people, listen, you know, mortgage brokers out here that have been making a boatload of money for the last year. You know, if they're out of work for a couple months, like they can afford to make their mortgage payments. It shouldn't be a foregone conclusion. What advice do you have learning from the last housing crisis and seeing some of the things that are being vocalized right now? How can we as loan originators and brokers really make sure that we understand we are the first line of defense and we're educating our customers on what they need to be doing?
Yeah, I think the tagline is very simple, which is forbearance is not forgiveness. And I think once, kind of that part is understood, then I think it's frankly, Anthony, it's incumbent upon us and our peer lenders to help you all educate the borrower to a greater extent than that. But the simple tagline is forbearance is not forgiveness. And that's what is missed when, a politician gets up and says, hey, you don't have to make your payment. It's like, wow, well, that sounds great. It's like, you're not relieved of the obligation. You simply, this is for relief in a hardship circumstance. So I think kind of that simple tagline, and then we and others should help you help the originators out there really try to explain it more cogently to the borrowers out there.
Absolutely. Well, Willie, we got you for 40 minutes. We really appreciate the time. We appreciate Home Point Financial. There's a lot of brokers in this community that value Home Point at a very high degree. You guys have really pulled through during these tough times, and you're keeping your turn times fast. You're a true partner to the lender. You're protecting the relationship brokers have with their customers, and more than anything, you guys are leading. So, thank you very much.
Hey, one more thing. Can I do one little quick thing? Come on, Anthony. Give me a couple minutes here.
Please, you got it. Go for it.
All right, cool. So I was talking about the resiliency of our associates and adaptability, and I'll tell you a little anecdote, which is about our partners. So over the last several, really kind of 2 to 3 weeks, there's been days that have been really significant from a volume standpoint. And we've kind of looked at each other and said, this has to be it, right? Because of all the things that are happening out there in the world. And it's like, this must be the last hurrah, or this must be like everyone just saying, okay, I'm done working, so here's all my loans, or here's. We have said that probably 4 or 5 times in the last, say, 3-4 weeks. And so, as much as I admire the resiliency and the adaptability of our associates, I equally admire the resiliency and adaptability of our partners, because again, without them, we don't exist. And they've proven me wrong now at least 3 or 4 times, because I've been like, it's got to be the last hurrah, right? And it's like, nope. Yesterday was another one. So
yeah, I don't think I can tell you. I think the one thing that I've learned is that mortgage brokers, these are small business operators, and they are very much used to working from home. Yeah. And I can tell you that it's been I'm at the office right now, but I've been trying to work from home. And it does take some, it's a challenge if you're used to going to an office every day. But these guys are 12 o'clock at night, 1 o'clock in the morning. My phone's blowing up constantly. These guys work 24 hours a day. So, I'm proud of the efforts that's being made. And my big message to them has been, now more than ever, we just have to be understanding that the game plan, the game is changing, and we have to roll with the punches. And it's not going to be always fun. Change is not always fun, but at the same time, we have to be compassionate, because at the end of the day, our objective is to serve consumers.
For sure. We'll figure it out together. And
absolutely. I appreciate you, Willie.
Stay safe, everybody.
Absolutely. Thank you.
You got it.